Hello everyone, how are you doing today? I hope everyone is great and doing excellent. Okay, today we're going to talk about capital budgeting decision models. What does that mean in general? It means that if we are offered few project, then or even one project, then should we accept the project or we should reject the project? How are we going to make decision on that? This is called decision making, yeah, or capital budgeting. Learning objectives. Explain capital budgeting and differentiate between short-term and long-term budgeting decisions. Explain the payback model and its two significant weaknesses and how the discounted payback period model addresses one of the problems. Understand the net present value decision model and appreciate why it's the preferred criterion for evaluating proposed investments. Calculate the most popular capital budgeting alternative to the net present value. The initial rate of return, internal rate of return, which is called IRR. And explain how the modified internal rate of return, which MIRR model attempts to address the IRR's problems. Understand the profitability index PI as a modification of the net present value model. Compare and contrast the strengths and weaknesses of each decision model in a holistic way. Okay, short-term and long-term decisions. Long-term decisions versus short-term decision. Longer time horizons cost larger sums of money and require a lot more information to be collected as part of their analysis than short-term decision. Here it shows that what's the difference between making a decision between long-term and the short-term projects. And capital budgeting meets all three criteria. It means that we're gonna need some techniques in order to choose among projects, which is called capital budgeting. Three key things to remember about capital budgeting decisions include typically a go or no-go decision on a product, service, facility or activity of the firm, requires sound estimates of the timing and amount of cash flows for the proposal. The capital budgeting model has a predetermined accept or reject criteria. Later we're going to see each one of these in details. Okay, the first method is called payback period, which later we're going to see discounted payback period, net present value, IRR, MIRR, PI. There are many different methods that can be used in order to evaluate the project, accept or reject the projects. But why we have many different techniques is that no technique is a perfect technique. Then, in order to evaluate any project, we need to use few different methodology or the techniques that come up to a conclusion and make decision to accept or reject a project. Okay, right now we're gonna see the payback period. The length of time in which an investment pays back its original cost. That's a definition for the payback period. It means that how long does it take time to recover the initial outlay. Payback period, the cutoff period, and the vice versa means that the management gonna decide that okay, they want to get back their money maybe in 2 years or 3 years, and then they can evaluate the project by this method. Thus, its main focus is on cost recovery or liquidity. The method assumes that all cash outflows occur right at the beginning of the project's life, followed by a stream of inflows. Also assumes that cash inflows occur uniformly over the year. Thus, if cost is equal to $40,000, cash flow per year is $15,000. For 3 years, the payback period would be around 2.67 years. It's almost 3 years. Okay, let's see an example here. Payback period of a new machine. Let's say that the owner of Perfect Images Salon is considering the purchase of a new tanning bed. It costs $10,000 and is likely to bring in after tax cash inflows of $4,000. in the first year, $4,500 in the second year, and $10,000 in the third year, and $8,000 in the fourth year. The firm has a policy of buying equipment only if the payback period is 2 years or less. Calculate the payback period of the tanning bed and state whether the owner would buy it or not. Okay, as we can see, it's gonna cost us around 10,000, and in year one, it's gonna return 4,000, and in year two, it's gonna generate 4,500. 4,000 plus 4,500 is 8,500, which is less than the initial outlay, which is 10 years. Then this project is rejected actually. Let's see here in details that. See here all the years, and here is the cash flows. This one shows the cash outflow. Here are the income or the cash inflow. And then see, in the first year, we earn 4,000. In the second year, we earn 4,500. When we add these two, is 8,500, which is lesser than the initial outlay. Then we reject this project. That's simple. Okay, the payback period method has three major flaws, means these are some disadvantages or the problem of this period. This method. It ignores all cash flows after the initial cash outflow has been recovered. What does that mean? See, this project is earning around $10,000 or $8,000. See here, $8,000 or $10,000 per year after year 3 and 4. But based on this method, these two are completely ignored. It ignores the time value of money. See, we just simply added these two cash flows, the 4,000 and the 4,500. We didn't incorporate the discounting factor and the time value of the money, which is the flaw and the problem of this method. It ignores the riskiness of the cash flows as well. Okay, what to do? In order to overcome some of these issues, there is another method which is called discounted payback period. This method calculates the time it takes to recover the initial investment in current or discounted dollar. Keep it simple, it means that all the cash inflows would be discounted back to the present time and compare it with the initial outlay. Incorporate time value of money by adding up the discounted cash inflows at time 0 using the appropriate hurdle or discount rate, and then measuring the payback period. It is still flawed in cash flows after the payback is ignored. See, still this model has few issues. Okay, let's see the example. Calculate discounted payback period. Calculate discounted payback period of the tanning bed stated in example 1 above by using a discounted rate of 10%. Okay, what does that mean? It means that this cash flow and this cash flow should be discounted back to the present time. Okay, we are paying 10K. And how much we are earning for year 1? 4,000. Here is 4,500. And what we're supposed to do, we're going to bring it to the present time. We're going to bring this one also to the present time, discount it, and add these two minus this one. And see this amount is positive or negative. Okay, how it works means that 4,000 divided by 1 point, how much was the, okay, 10%. 1.1 to the power of 1 plus 4,500 divided by 1.1 to the power of 2. And then we add these two numbers together. And we see that, and we minus the 10,000. And it shows that it takes more than 2 years to recover the 18,000K. And in this case also the project would be rejected. Okay, the third method that we're gonna see is called NPV or net present value. This counts all the cash flows from a project back to time 0 using an appropriate discount rate R. Okay, if this is our timeline, if this is the timeline that we have, and then if we have cash flows here, and we have cash flows here, then what we're gonna do, and here also was the initial outlay that we had, then we're gonna bring it to the present time. We're gonna bring all this to present time, all these cash flows to the present time, add all this together minus this one. And see here, this is the initial outlay, and these are the cash flow of year 1, year 2, year 3, and it goes to the infinity. And then if the net present value is bigger than 0, then we accept the project. And if it is less than 0, we reject the project. What does this mean? Why we need to accept it when it is bigger than 0? It means that we are creating some value to the company, for the company. A positive NPV implies that the project is adding value to the firm's bottom line, and therefore, when comparing project, the higher the NPV, the better. Okay, let's see an example. Calculating NPV. Using the cash flows for the tanning bed given in example 2 above, calculate this NPV and indicate whether the investment should be undertaken or no. Okay, the simple formula that we have, see, this is the initial outlay, this is the cash inflow of year 1 divided by the discount factor. The same story, the cash flow divided by discount factor year 2, and cash flow of inflow of year 3 divided by the discounting factor of year 3, and cash inflow of year 4 divided by the discount factor for the year 4. And then when we calculate all these numbers, minus it with the 10,000, it shows that, oh, okay, actually we are creating $10,332.62 for the company. It means that the NPV is bigger than 0, and we're gonna accept the project, and we're gonna buy the tanning bed. Okay, mutually exclusive versus independent project. What is the meaning of mutually exclusive? It means that if we have few projects, we're just supposed to choose one project. Why? Because we have limitation in our constraint, in our resources. NPV approach useful for independent as well as mutually exclusive projects. A choice between mutually exclusive projects arises when there is a need for only one project and both projects can fulfill that need. There is a scarce resource that both projects need, and by using it, one project is not available for the second. NPV rule considers whether or not discounted cash inflows outweigh the cash outflows emanating from a project. Higher positive net present values would be preferred to lower or negative net present values. Decision is clear cut. Okay, let's see. Now we have two projects here, tanning bed and tanning booth. But which one to choose? Because we have just limited amount of money, limited amount of resources, then we cannot run both projects at the same time. We need to decide. This is called mutually exclusive. Why? Because we just want to choose one of these projects. The owner of Perfect Images Salon has a dilemma. She wants to start offering tanning services and has to decide between purchasing a tanning bed and a tanning booth. In either case, she figures that the cost of capital will be 10%. The relevant annual cash flows with each option are listed below. See, we have the cash outflow, cash inflow, cash outflow, cash inflow for both projects. Can you help her make the right decision? Okay. The same story, nothing new. We just calculate the net present value of the bed versus the bourse. Okay. We see that the first project is creating this much of net present value and the other one creating this much of net present value. And which one is bigger? This project's net NPV is bigger than the other one. Thus, the less expensive tanning bed with the higher net present value is the better option, which is the first one. Okay, but in some situation we have project that the life is not equal, is an unequal. Then how to compare these two projects? Then there are different methods that we can use. Firms often have to decide between alternatives that are mutually exclusive, we already have learned it, cost different amounts, and have different useful lives, and require replacement once their productive lives run out. In such cases, using the traditional net present value single life analysis as evaluation criterion can lead to incorrect decisions, since the cash flows will change once replacement occurs. Let's see how can we overcome these issues. Okay, there are two techniques that we can use for the unequal lives of projects. Under the NPV approach, mutually exclusive projects with unequal lives can be analyzed by using one of the following two modified approaches. Replacement chain method, and the other one is called EAA, equivalent annual annuity approach. Let's see. Let's say that there are two tanning beds available. One lasts for 3 years while the other for 4 years. The owner realizes that she will have to replace either of these two beds with new ones when they are at the end of their productive life, as she plans on being in the business for a long time. Using the cash flows listed below and a cost of capital is 10%, help the owner decide which of the two tanning beds she should choose. As we can see the life of this project are not the same. One is 3 years and another one is 4 years. What to do? Okay, these are the cash inflow and outflows that we have. And this is also cash inflow and outflow for the second project. And as you can see, here we don't have anything. Okay, what to do? Using the replacement chain method. Calculate the net present value of each tanning bed for a single life. Okay, we already have done this previously up to here. Nothing is new for us, is it? Okay, what is the next step? Next, calculate the total NPV of each bed using 3 repetitions for A and for B. For example, we assume the bed A will be replaced at the end of years 4 and 8, lasting 12 years, while bed B will be replaced in years 3, 6, and 9, also lasting for 12 years in total. See, this project has the life for 4 years and this one has 3 years. We try to find the common denominator, the smallest number that can be divided or divisible between these two, which is 12. Yeah, that's why here, as you can see, they're choosing number 12. It's the smallest number that can be divided by 4 and 3. This is how this technique works. Okay. This is the net present value we already have calculated for project A. And then what we're gonna do then, net present value divided by 1. Okay, let me draw the Okay, if this is first 4 year, this is 8, and this is year 12. We already have calculated the net present value of these cash flows already had here. If you remember, this is the amount. And okay, the net present value for the cash flows for this period, okay, is here, which is equal to 10,332.62. Then we bring this number, discount it to year 0. That's why here we have the power 4. And the same story here, because we assume that you are repeating, isn't it? Okay, the present value of these numbers, we just bring it at this point, is 10,033.62, and then okay, we bring this amount to the present time, which is 8 years. Okay, then we add all these numbers together, gonna give us this number. And we do the same story for this one. We already have this much. And then if we just draw the timeline, year 3, year 6, and here is year 9, and then we do the same story for the cash flows that we have for each period, and we add all these things together and gonna give us this number. See, and we compare the net present value of the first project and the second project and see which one is bigger. It shows that the bet B with its higher total net present value should be chosen. Okay, let's see the another method, which is called EAR, or equivalent annual annuity. This is the way we're gonna follow. We simply convert each project's NPV into an equivalent annual annuity, as shown in equation below, by using the present value of an annuity equation or calculator function, and choose the one with the higher EAA. Okay, in order to find the PVIFA, which stands for present value interest factor for a $1 annuity discounted at a K percent for n periods. Okay, we refer to this type of a table. And then, okay, for project A, we already have the NPV, and we're supposed to find this one. It's already given to us, and the life of this project was 4 years. Then we just refer to this project, and we find the 10%, and for this year, then the intersection here is 3.1699. That is the number. And we do the same thing. We already have this one. And okay, we know this one. The life of this project is 3 years. Then we just refer here. And we find the number is 2.48. Divide these two together. And then we get this number. And we compare these two numbers. It shows that B has the producing higher amount. Okay, this part is saying that how you can use the calculator. If you have calculator, then you can follow these steps in order to learn how to work with the calculator, financial calculator. Yep. Okay, another method is called IRR, internal rate of return, which the answer is in terms of percentage. Okay, so far we have learned payback period, discounted payback period, Net present value, under the net present value also, we learned about the unequal life of the project, that EAA and the replacement chain. Right now we're going to learn about the internal rate of return. This is another method that we can evaluate the project in order to accept or reject the project. The IRR, the internal rate of return, is the discount rate which forces the sum of all the discounted cash flows from a project to equal 0, as shown below. Means that whenever we assume that NPV equal to 0, if you remember the formula, then we set it equal to 0, and we look for this R. This R is called IRR. We already have these cash flows. We all know all these years. We know this one. Then in here we just equal it to 0, and we try to find this R, which is called IRR. The decision rule that would be applied is as follows. If IRR, the number that we find, is bigger than the discount rate or the Holler rate, it means the net present value is bigger than 0. We accept the project. The IRR is measured as a percent, while the NPV is measured in dollars. Okay, look at this graph. We assume that this axis here is the different discount rates, and here this axis is our NPV. Okay, we try to find the net present value of the projects with different cash with different discount rates. We change the discount rate, we find the NPV. We change the discount rate, we find the NPV of the project. This is called sensitivity analysis. We want to know that how the NPV of the project gonna change with the higher or lower discount rates. Okay, it means that we are adjusting our project based on a different discount rate, which somehow the discount rate is the proxy for the risk. Okay, and this is the point that, as we mentioned, that NPV equal to 0, this is how we find the IRR. And whenever the NPV is equal to 0, that's the point here that the graph for the NPV touches this axis X. Okay. Okay, one of the point is that, see, in order to find the IRR, if the IRR as the power of 2 means that the life of the project is up to 2 years, it's still okay, we can find the IRR manually. But if the life of project is more than 2 years, 3, 4, 5, and more than that, then it's not that easy to find the IRR. Then we need to use the financial calculator or the Excel, actually, spreadsheet. Okay, it says that using the cash flows for the tanning bed given in example 1, above, calculate the IRR and state your decision. Okay, how it works? Okay, means 10K plus 4K divided by 1 plus IRR to the power of 1 plus 4,500 divided by 1 plus IRR to the power of 2 plus 10K divided by 1 plus IRR to the power of 3 plus 8K divided by 1 plus IRR to the power of 4. Then we need to find the IRR, the root of these equations. And as you can see, the equation that we have here has a power of 4, then it's not that easy to find it manually. That's why we need either spreadsheet Excel or the financial calculator. When we find the IRR, then the IRR of this project is 10%. And then we need to compare this 10% with the hurdle rate or the cutoff point that we have. If the IRR is bigger than the discount rate, then we accept the project. Otherwise, we reject the project. Okay, appropriate discount rate or hurdle rate. Discount rate or hurdle rate is the minimum acceptable rate of return that should be earned on a project given its riskiness. What does this mean? It means that the particular project should have this particular hurdle rate or a return actually. Otherwise, accepting this project is not feasible and logical. For a firm, it would typically be its weighted average cost of capital, which later we're going to learn about the weighted average cost of capital. This weighted average cost of capital could be also the same as discount rate or the hurdle rate that we are talking about. Sometimes it helps to draw on NPV profile. For example, graph plotting various net present values for a range of incremental discount rates, showing at which discount rates the project would be acceptable and at which rate it would not. Okay, table 9.2, net present values for copier A with varying risk levels. The point where the NPV line cuts the x-axis is the IRR, which already have covered this part of the project. For example, the discount rate at which the net present value equal to 0. Thus, at rates below the IRR, the project would have a positive NPV and would be acceptable and vice versa. What does this mean? Okay, if you remember that, I just mentioned that, if we assume this axis is NPV, this one is discount rate, then we can do the sensitivity analysis, find the NPV with the different discount rates. And here is the IRR. The IRR should be bigger than the discount rate or the hurdle rate. As you can see here, when the discount rate that we have is keep increasing, net present value, which here is equal to 0, start to become lesser than 0 or negative. Then we're gonna accept the project if it is in this area. If the project starts to create a negative net present value, means that project is not profitable at all and not worth to accept. See here, the net present value here is becoming negative. Why? Because the discount rate here is going beyond the IRR. Okay, problems with internal rate of return and the IRR that we have. As we already have mentioned, no model is a perfect model. It has its own drawbacks and issues. In most cases, NPV decision equal to IRR decision. That is, if a project has a positive NPV, its IRR will exceed its hurdle rate, making it acceptable. Similarly, the highest NPV project will also generally have the highest IRR. However, there are some cases when the IRR method leads to ambiguous decision or is problematic. In particular, we can have two problems with the IRR approach: the multiple IRRs and the unrealistic reinvestment rate assumption. Let's see. Multiple internal rates of return. Projects which have non-normal cash flows, as shown below, multiple sign changes during their lives often end up with multiple IRRs. What does that mean? See, in general, we assume that, okay, there is initial outlay, the rest all are cash inflows. Positive, positive, positive. But what if in between somewhere we have some cash outflows? See here is positive, positive, cash inflow, suddenly cash outflow. Then due to the sign changes, we're gonna have something as the name of multiple IRR. As you can see, there is two roots here, one this one and this one. See, the IRR, one would be 5.62%, another one would be 27.78%. Then that creates some issues. Typically happens when a project has non-normal cash flows. For example, the cash inflows and outflows are not all clustered together. For example, all negative cash flows in early years followed by all positive cash flows later, or vice versa. If the cash flows have multiple sign changes during the project's life, it leads to multiple IRRs and therefore ambiguity as to which one is correct. In such cases, the best thing to do is to draw an NPV profile and select the project if it has a positive NPV at our required discount rate and vice versa. See, we still need to refer to the NPV profile if we have the multiple IRR. Okay. Another one, if you remember, another issue was the reinvestment and the crossover rates. Let's see what does this mean. Another problem with the IRR approach is that it inherently assumes that the cash flows are being reinvested at the IRR rate, which is unusually high, can be highly unrealistic. In other words, if the IRR was calculated to be 40%, this would mean that we are implying that the cash inflows from a project are being reinvested at a rate of a return of 40% for the IRR to materialize. What does this mean? If you remember here that when we have cash inflow, these are the income for us. We assume that we are not withdrawing any of these money. We just, whatever we earn here, we earn here, we earn here, we earn here, we reinvest it with the IRR rate. This is an assumption behind the calculation of the IRR, which is actually unrealistic. Because when we have an income, we will withdraw from that income. And we're gonna spend it somewhere else. We're just not gonna just leave the income be there, stay there. A related problem arises when, in the case of mutually exclusive project, we have either significant cost differences and or significant timing differences, leading to the NPV profiles crossing over. See, we have two projects, project A and project B. This is the NPV of project B. This is the NPV of project A. Based on the NPV comparison, which one we're supposed to choose? We're supposed to choose project A, isn't it? Because it's giving a higher NPV. But when we draw the net present value based on a different discount rate, and then now we want to decide based on the IRR. Right now, see which one has a bigger IRR. Project B has a bigger IRR than project A. Oh, NPV is saying that choose project A, but IRR is saying choose project B. Then which one we're supposed to refer to? This point that there is an intersection between these two projects, or the NPV at this point. See, this rate gives the same NPV for both projects. This point is called crossover rate. Notice that project B's IRR is higher than project A's IRR, making it the preferred choice based on the IRR approach. However, at discount rates lower than the crossover rate, project A has a higher NPV than project B, making it more acceptable since it's adding more value. Reinvestment and crossover rates. If the discount rate is exactly equal to the crossover rate, both projects would have the same NPV, means here. To the right of the crossover point, both methods would select project B. See here? And this is the right side of the crossover. Here talks about the left side of the crossover rate. The fact that certain discount rates we have conflicting decision being projected by the IRR method vis-a-vis the NPV method is the problem. So when in doubt, go with the project with the highest NPV. It always be correct. Okay? When we have these issues, we always refer to the NPV. Reinvestment and crossover rates. Example, calculating the crossover rates of two projects, Project A and Project B. Listed below are the cash flows associated with two mutually exclusive Project A and B. If you remember what is mutually exclusive means, you're supposed to just choose either A or B. Calculate the crossover rate. Okay. If you remember the NPV equal to 0, gonna give us the IRR for project A, IRR for project B. How to find the crossover rates? Then we follow this technique, incremental. A minus B means negative 10,000 minus 7,000 will give us the 3,000, and we do the same thing. 5,000 minus 1,000, 7 minus 5. 9 minus 2000 and then we do the same technique. NPV equal to 0 gonna give us the IRR, or this is the crossover rate. Okay, now to check this, calculate the NPVs of the two projects at different discount rate. This is the crossover rate. Net present value of project A at 0 discount rate, 10% discount rate, net present value of project B with a different discount rate. Okay. And here with different discount rates. As you can see, after this point, this discount rate, see this one, the net present value of project A become negative, and here is still a 0. Okay, the internal rate of return rule. Okay. Take any investment where the IRR exceeds the cost of capital. Turn down any investment whose IRR is less than the cost of capital. The IRR investment rule will give the same answer as the NPV rule in many, but not all situations. In general, the IRR rule works for a stand-alone project if all of the project's negative cash flows proceed its positive cash flows. Okay, applying the IRR rule. In other cases, the IRR rule may disagree with the net present value rule and thus be incorrect. Situation where the IRR rule and the NPV rule may be in conflict. Delayed investment, non-existent IRR, and multiple IRR. Let's see an example. Delayed investment. What does this part mean? Assume you have just retired as the CEO of a successful company. A major publisher has offered you a book deal. The publisher will pay you $1 million upfront if you agree to write a book about your experiences. You estimate that it will take 3 years to write the book. The time you spend writing will cause you to give up a speaking engagement amounting to $500,000 per year. You estimate your opportunity cost to be 10%. How to calculate the opportunity cost is like here, yeah? It's like here that first year you would be pay 1 million, but the other years 5K, 500K, and 500K. Then we can calculate the IRR or the rate by the help of Excel, which would be equal to 23.38%. And the IRR is greater than the cost of capital. Thus, the IRR rule indicates you should accept the deal. Or you can see the calculation here. Let's see here. Here talks about the net present value. Based on the net present value, this is negative. And it says that we're supposed to reject the deal. IRR is saying that accept, and net present value here is saying that reject the project. When the benefits of an investment occur before the costs, the NPV is an increasing function of the discount rate. Means here, increasing. Multiple IRRs. Suppose Star informs the publisher that it needs to sweeten the deal before he will accept it. The publisher offers $550,000 advance and $1 million in 4 years when the book is published. Should he accept or reject the new offer? Okay, let's draw the timeline and see how it works. Okay, this is the deal, this is, and this is. Then calculate the net present value and also the IRR. In here, we're trying to find the IRR. See the sign here, negative, negative, negative. And this one's supposed to be plus, I guess. Okay. By setting the NPV equal to 0 and solving for R, we find the IRR. In this case, there are two IRRs, 7.16% and 33.67%. Because there is more than one IRR, the IRR rule cannot be applied. See here? We got two IRR. As seen in this figure, between 7.16% and 33.67%, the book deal has a negative NPV. See here? The NPV is negative. Since your opportunity cost of capital is 10%, you should reject the deal. Okay, another pitfall is called non-existence IRR. Finally, Star is able to get the publisher to increase his advance to $750,000 in addition to the $1 million when the book is published in 4 years. With these cash flows, no IRR exists. There is no discount rate that makes net present value equal to 0. Okay? See, the NPV is not really crossing the axis here, the discount rate axis here. No IRR exists because the NPV is positive for all values of the discount rate. Thus, the IRR rule cannot be used also here. Okay, common mistakes. IRR versus the IRR rule. While the IRR rule has shortcomings for making investment decisions, the IRR itself remains useful. IRR measures the average return of the investment and the sensitivity of the NPV to any estimation error in the cost of capital. Okay, now due to having some issues, some flaws, some pitfalls for the IRR, is another method can overcome some of those issues, which is called MIRR, means modified internal rate of a return. Despite several shortcomings, managers like to use IRR since it is expressed as a percentage rather than in dollars. The MIRR was developed to get around the unrealistic investment rate criticism for the traditional IRR. Under the MIRR, all cash outflows are assumed to be reinvested at the firm's cost of capital or hurdle rate, which makes it more realistic. We calculate the future value of all positive cash flows at the terminal year of the project, the present value of the cash outflows at time 0 using the firm's hurdle rate, and then solve for the relevant rate of return. That would be implied using the following equation. Okay, see, this is an example that we have all these cash flows, cash flow, cash flow, cash flow, and then we take all these to the future value. This one is already in the future value. Then this one, we take it to the future value for 1 year. This one, we calculate the future value for 2 years. This is 3 years, and this is for 4 years, and we add all these numbers together. And future value of cash inflows reinvested at 13%, for example. In here, the reinvestment was 20%, 23% actually, but here we assume that this is 13%, 13%. See, we take all these things to the future time. Okay, example, calculating the MIRR. Using the cash flows given in example 8 above and a discount rate of 10%, calculate the MIRRs for project A and B. Which project should be accepted? Okay, nothing new. This is it, and also the crossover rate is this much. Okay, project A, present value of cash outflows at time 0 is given to us, see, 10,000 from the table. And future value of cash inflows at year 3 at 10% rate is already given. It means that we take these 3 values to the future time for project A. And then we're gonna get this number. Okay, what we do? Then future value divided by the present value to the power of 1 over 3 minus 1 gonna give us this number, which is the MIRR for project A. And the same story we just repeated for project B as well. Then we compare MIRR of project A and project B. And which one is higher? Project B's MIRR is higher, which we accept that project. Okay, the last method is profitability index. This is another method in order to evaluate the projects. If faced with a constrained budget, choose project that gives us the best bang for the buck. The profitability index, or the PI, can be used to calculate the ratio of the present value of benefits inflow to the present value of the cost of a project as follows. Yeah. In a sense, it tells us how many dollars we are getting per dollar invested. Okay, NPV plus cost divided by the cost. We calculate the NPV of the project, add it to this cost, 17,000 divided by the 10,000. This is the PI for project A. This is the PI for project B. Then which one is giving us the higher profit? Project B. Overview of 6 decision model. In here, just comparing the pros and cons of the different models. Payback period. Simple and fast, but economically unsound. Ignores all cash flows after the cut-off date. Ignores the time value of money and riskiness of cash flows. Discounted payback period. Incorporates the time value of money. Still ignores cash flow after the cut-off date. Net present value, NPV, economically sound, properly ranks projects across various sizes, time horizons, and levels of risk, without exception for all independent projects. IRR provides a single measure, a return, has the potential for errors in ranking projects, can also lead to an incorrect selection when there are two mutually exclusive projects, or incorrect acceptance or rejection of a project with more than a single IRR. MIRR corrects for most of, but not all, the problems of IRR and gives the solution in terms of a return. The reinvestment rate may or may not be appropriate for the future cash flows. However, the PI incorporates risk and return, but the benefits to cost ratio is actually just another way of expressing the NPV. Okay, here also puts everything, all the pros and cons in a table for you. Thank you very much, guys. That's the end of the lecture.